Welcome to the Deep Dive. For the show that gives you those critical insights, without all the noise.
That's the idea.
Today, we're really taking a close look at Artisan Partners Asset Management, ticker APAMHAM. We're digging into their Q2 2025 earnings call.
Yep.
Our goal here is to basically unpack their financials, understand this big strategic shift they seem to be making, and figure out what it all means for them going forward.
Exactly. So you'll get a concise but pretty thorough breakdown. What management said, how they're steering things, and how the market took the news initially.
Should give you a really clear picture of Artisan's latest quarter.
Mm-hmm.
Okay, let's jump right in then. Headline numbers for Q2 2025. What's the quick snapshot?
All right. So Artisan Partners reported GAAP EPS, that's generally accepted accounting principles, earnings per share of 94 cents.
Oh, hi.
Which is a decent step up from Saturday at 80 cents the year before.
Right.
Their non-GAAP or adjusted EPS, that came in at idle 83 cents.
Mm-hmm.
That was just, slightly ahead of the consensus estimate, which was around idle 82 cents.
Just beat it.
Okay. And revenue?
Revenue hit $282.8 million for the quarter. That's up 4% year over year.
Okay.
And that also came in above what analysts were expecting.
Good numbers so far. What about assets under management, AUM?
Yeah, AUM actually hit a record $175.5 billion at the end of the quarter.
Wow. Record high.
Yep. That's an impressive 8% increase just from the previous quarter and 10% up from last year.
I think I saw something about outflows despite the record AUM.
Yeah, that's the other side of the coin. The company saw net client outflows of $1.9 billion during Q2.
Ah, okay. So a bit of a mixed signal there. Record assets, but clients pulling money out.
Exactly. It's a nuanced story, like you said. Profitability metrics, though, they look solid.
Okay.
GAAP operating margin was 28.2%. Adjusted operating margin came in at 31.7%.
Very healthy margins.
Yeah. And adjusted EBITDA, which is a good measure of, core operational performance, that stood at $94.2 million.
Right.
They also bumped up the dividend, declared a quarterly dividend of 73 cents per share. That's a 7% increase over Q1. Okay, so solid results, higher dividend.
Mm-hmm.
But what was the market reaction? You mentioned it was muted.
It really was, yeah. Quite muted. The stock price stayed largely flat right after the announcement, which, despite beating estimates on EPS and revenue, suggests maybe investors are looking a bit deeper or perhaps weighing those outflows more heavily.
Interesting. Maybe it has something to do with the leadership changes happening there. Seems like a big shift at the top.
That's definitely part of the context. You're right. A significant changing of the guard. Jason Gottlieb took over as CEO in June.
Right. Replacing Eric Colson.
Exactly. Eric Colson transitioned to executive chair. And this was actually his 50th and final quarterly call as CEO. Quite a run.
50 calls. Wow.
Yeah. It's like, the end of an era in some ways.
Yeah.
But Jason Gottlieb, the new CEO, he really emphasized continuity.
Okay.
Said Artisan Partners will stay a high value-added investment firm designed for talent to thrive in a thoughtful growth environment.
So evolution, not revolution, perhaps. Sort of. But they have been evolving quite a bit already. They've methodically expanded, from just public equities originally to now having fixed income alternatives. It's a multi-asset platform. And a big piece of this is their focus on intermediated wealth clients.
Working through advisors and platforms.
Exactly. And that channel now represents over half of their total AUM. So that's a big shift in itself over time.
Okay, so leadership change, but also this ongoing platform evolution.
Yeah.
Let's dig into that strategic part more. You mentioned diversification. What's the big play here?
Yeah, this is where it gets really interesting, I think. Management was very clear about a strategic pivot. They want to diversify their revenue base.
Makes sense.
And they have a strong interest in expanding into alternative and private markets.
Why the push there specifically?
They spelled it out pretty clearly. They're chasing, and I quote, more attractive fee-risk economics compared to just traditional long-only stocks.
Higher fees, stickier assets, potentially. That's the idea. Specific areas they mentioned, value add to opportunistic real estate, private equity secondaries.
Okay, secondaries.
Yeah.
Faster return of capital, right.
Exactly. The shorter duration to DPI, distributed to paid-in capital, gets money back to investors quicker.
Yeah.
And also asset-based lending within private credit.
Right.
And they made a point of distinguishing that from the typical sponsor-driven private credit deals.
Interesting distinction. And M&A, is that on the table?
Very much so. Gottlieb explicitly called M&A a potent opportunity going forward,
Okay.
especially in these alternatives areas. But always, he stressed, with a focus on talent first. And it has to be a talent-driven deal.
So acquiring teams or capabilities, not just assets. But if they're pivoting towards something, are they also pivoting away from anything, cleaning house a bit?
They are. Yes,
Yeah.
exactly. They're actively pruning. The China post-venture strategy, for instance, is being wound down.
Okay.
That led to a $1.2 million charge in Q2. But the flip side is they expect about $2.4 million in cost savings starting in Q3 from that wind down.
Right, it makes sense.
And at the same time, they're launching new things. Earlier this year, they launched a global special situation strategy within their international value group. So it's trimming and building simultaneously.
This focus on talent, the new CEO mentioned it, M&A is talent-driven. It seems like they're getting some external validation too, some awards.
Oh, absolutely. And it's pretty impressive validation. Brian Krug, who heads up their credit team, he won Morningstar's 2025 Investment Excellence Award for Outstanding Fixed Income Portfolio Manager.
That's a big one?
It is. His team manages over $13 billion, and their main high-income strategy has beaten its benchmark by 170 basis points a year after fees since it started.
Wow.
And then there's David Samra from the International Value Group. He was a finalist for the 2025 U.S. Morningstar Award for Outstanding Equity Portfolio Manager.
Another one?
Yeah. His international value strategy compounded capital at nearly 11% annually for 23 years, outperforming its benchmark by over 400 basis points. Just incredible long-term performance.
23 years.
And one more. Lewis Kaufman's Developing World Strategy just hit its 10-year mark in July. It's compounded at almost 11.6% annually, beating its index by nearly 700 basis points after fees.
Those are some seriously strong track records. Alpha generation is clearly there in pockets.
Definitely. It shows they can attract and, crucially, retain that kind of market-beating talent.
But let's circle back to the flows. We've got these star managers, incredible track records, yet still $1.9 billion walked out the door overall in Q2. How does that square? Are these wins not translating yet, or is the pressure just that intense?
That is the kind of the core tension right now. You're absolutely right to ask. While the overall number was negative, there are bright spots within the flows.
Okay.
All 5 of their emerging market strategies actually had positive net flows year to date, added up to about $700 million.
So EM is attracting assets.
Yes. It shows there's definitely growing interest and demand there, and fixed income, as a category, saw its 12th straight quarter of positive flows.
12 quarters for fixed income. Okay, that's a trend.
So some segments are clearly bucking the outflow trend and represent, real growth vectors for them, even amidst the broader pressure.
Got it. So even with this talent and these pockets of success, managing the whole operation, capacity, capital, that's crucial, right? Especially with this pivot.
Absolutely critical. Yeah. Yes, market appreciation drove that record AUM number, but you can't ignore the $1.9 billion in outflows. It highlights those ongoing industry challenges for active managers. Everyone's fighting for flows.
And fees. Did they mention the average fee rate?
Yeah, the weighted average recurring fee rate was about 68 basis points.
Yeah.
Actually ticked up slightly from the previous quarter.
Okay. And costs. I assume they went up with revenue.
They did. Operating expenses increased, mainly due to higher incentive comp, tied to the higher revenues, and also market appreciation, boosting the value of long-term incentive awards, basically paying for performance.
Right. Which you want to see. How about the balance sheet? Are they positioned to fund this alternatives push? Maybe do those M&A deals they talked about?
They seem to be in a strong position. They have about $140 million of their own seed capital invested in products right now.
Okay.
And they actually expect to be able to redeem some of that over the next, say, 12 to 18 months.
Freeing up cash.
Exactly. Which could then be used for more seeding or potentially for acquisitions.
Yeah.
Management also said they're not really a fan of debt, but they do have room on their credit facility and, additional debt capacity if the right M&A opportunity comes along.
So they have dry powder if needed.
Seems like it. They also just closed on $50 million in new private debt recently, mainly to retire $60 million of older notes that were maturing soon. Just balance sheet management.
Okay. And looking ahead to Q3, any hints?
No formal numbers. They don't give guidance like that, but they did suggest revenue should benefit from that 8% higher AUM level going into the quarter.
Right.
And also from not having those $2.4 million in costs tied to the China strategy wind down.
Yeah.
So maybe a bit of a tailwind there. Overall, they just expressed confidence in, compounding value and growing selectively.
Okay, so pulling it all together, there's this clear tension, isn't there? Record AUM, mostly from the market lifting all boats.
Right. Market tailwinds were huge.
Versus these persistent outflows. It feels like a microcosm of the whole active management industry struggle right now.
It really does. You see that dynamic playing out across the board. Active managers facing pressure on both the mix of assets and the fees they can charge. For Artisan, it sets up this, well, this interesting narrative.
And that muted market reaction makes more sense now, maybe. Investors seeing the good numbers, but focusing more on how sustainable those flows are, less on just the big AUM number itself.
I think that's exactly right. Management pushed the story of platform expansion, diversifying into alternatives, building for the future. But investors, at least for now, seem very focused on, can they stabilize the flows in the core business? And where's the near-term earnings leverage? But, those positive trends in emerging markets and credit, those are real growth areas to watch. And this whole strategic pivot towards being a more diversified, fee-durable platform is the big multi-year story.
So what should people watch for? Catalysts.
Definitely the monthly AUM updates, especially the flow component, any news on new alternative fund launches, and just any concrete evidence that flows are stabilizing across their main strategies. Those would be key signals.
Okay. Given that backdrop, the investor focus on flows, but management pointing towards this pivot, let's shift gears a bit. Time for our deep dive thesis segment.
The investment committee hats are on.
Exactly. We're calling this one the Alts Alpha Arbitrage Play. And obviously, standard disclaimer, this is just us talking, a thought experiment, absolutely not financial advice. Do your own homework.
Definitely not advice. Okay, so the thesis. Given Artisan's very clear focus on expanding into these higher margin alternative and private markets.
Right. Real estate, PE secondaries, asset-based lending.
Yeah. Those areas. We're thinking about a potential two-pronged strategy here, just hypothetical.
Okay, lay it out.
So for the long side, maybe long APM common stock itself, possibly paired with something like a longer dated call option, say a January 2027 $60 strike call. Just as an example.
And the thinking behind that long position?
The core idea is that the market might be currently undervaluing the impact of these alternative strategies. The higher fees, the potentially stickier assets. Maybe that's not fully baked into the stock price yet.
Because everyone's focused on the legacy equity outflows.
Perhaps. As management builds out these teams, launches new funds, maybe does some M&A like they hinted, we could see an inflection point in what we're calling flow durability. Something analysts focused only on the past might be missing.
In the Morningstar Awards, the track records, that supports the idea they can execute in high alpha areas.
Exactly. It shows they have the ability to attract and keep the kind of talent you absolutely need to succeed in alternatives. That's critical.
Okay, that's the long side. But you said two-pronged. What's the hedge? What's the short leg?
Right, got to consider the risks. The big one is just the overall pressure on active managers, those outflows we keep talking about, and maybe ongoing margin pressure from compensation costs.
The whole sector headwind.
Precisely. So to hedge that, the short leg could involve a short position in a broad-based active asset management ETF, something like KCE maybe, or FNCL.
So shorting the sector, basically.
Yeah, it acknowledges that while APAM is trying to pivot, the broader tide, passive investing, fee pressure, it's still a major factor for everyone in the space.
So it protects if APAM's pivot takes longer than expected, or if the whole sector just faces more pressure.
Exactly. It's a systemic hedge against those sector-wide issues.
And where's the arbitrage in this play?
Well, the potential arbitrage, as we see it, comes from this gap between the current narrative, record AUM, but outflows, and the potential future reality.
If the pivot works.
If the pivot works. The market might be too focused on the but outflows part, overlooking the early stages of this shift to what could be a higher margin, more resilient business model down the road.
And the signals are there. Winding down China, actively looking for M&A in alts?
Those are pretty clear signals, yeah. A firm actively trying to reshape itself. So you have this optionality diversifying revenue, maybe smoothing out the cyclical bumps plus the capital to potentially make acquisitions, it feels like, potentially an asymmetric risk-reward situation.
Meaning more upside potential than downside risk if things go right.
That's the idea. If they can actually deliver on stabilizing flows and building out these alternative platforms, we think the market might eventually re-rate APM. Stop seeing it as just another legacy active manager and start seeing it as a more diversified, higher value alternative investment firm.
Interesting thought experiment. Okay, let's zoom back out. What's the final takeaway here?
Okay, wrapping it up. Artisan Partners delivered a Q2 that, slightly beat expectations on the main financial lines. They hit record AUM, but that was largely thanks to the market providing a strong tailwind.
Right.
At the same time, they're navigating this big leadership change and very actively pursuing this strategic pivot, trying to diversify revenue, really pushing into higher margin alternatives and private markets, and also that growing intermediated wealth channel.
But the challenge remains, those net client outflows are still happening, even with strong performance in specific areas like credit and emerging markets.
Exactly, those outflows persist. Still, the strong performance pockets, their disciplined approach to managing capacity, and what looks like a solid balance sheet, those are potential catalysts for the future. It really is a firm in transition.
A fascinating moment of transformation, as you said.
It is. And just one last time, remember everyone, what we shared today, especially that last bit, just for discussion, doesn't constitute financial advice. Always do your own research. Talk to a financial professional before making any investment decisions.
Absolutely. So the big question hanging over Artisan Partners and for investors watching them isn't just, can they diversify successfully? It's maybe how quickly can this potential new higher value platform start to really overshadow the headwinds facing the older parts of the business? Is it a really smart reinvention playing out, or is it going to be a long drawn out transition in what's still a pretty tough market for active managers?
That's the story we'll be watching, still unfolding.
Definitely one to keep an eye on. Until next time, stay informed.